All right, this is International Paper's stock valuation. It is January 2022. And what we're looking at right now is the analysis that I did back in October of 21. Then I had a low of $40.57 and a high of 56.34. I do want to mention here that the high of 56.34 is predicated on possible earnings growth. And I came up with a high of 47 if we had earnings loss. So that's where we are. It is 3 months later. We've had an earnings report since then. We have another one due at the end of this month. So really interested to see that. Let's jump into this thing and see what we have here. Just really quick, just want to talk a little bit about the numbers that we see. This is cash. There is restricted cash on the books. And what that means is that International Paper currently has cash in the bank that they cannot touch, right? They can't touch it. So that number is included here in the balance sheet for cash. We'll play around with that here in a moment to see what some of the differences may be. Looking over the last 3 years, you can see that cash hasn't been anywhere near what it is now. A lot of that has to do with the fact that International Paper is getting out of the paper business, and so they've been selling a lot of their paper companies. The smart thing is, though, they are maintaining equity, so they're still receiving some money back. It's in the form of dividends from those sales, something like 20%, I think, in some cases. All right, receivables. I didn't do worst case, best case scenario on this thing. Again, that's something we can kind of play around with. Inventory is what it is. The other category, from my understanding, going through the financial statements, is basically their investments as far as hedges, right? So they have interest rate hedges, they have electricity hedges, they have foreign exchange rate hedges, and so that gets listed as assets because those are actual securities that they own, whether it be, like, say, contracts or stocks or whatever, right? Trees, of course, they do own trees. That hasn't changed a whole lot over the years. It has come down some, but anyway, we'll get into that. All right, and then investments, again, just what it sounds like. Again, these are going to be those hedges that we talked about. And then pension, they're old companies, so they still pay their employees a pension. Even if the current employees don't have a pension, they still have to pay pensions for the old employees. And then the right to use, I didn't get into this. I meant to, honestly, to figure out exactly what that is. But honestly, I figured it wasn't very consequential because the number hasn't moved around a whole lot. So really no need to look at it there. All right, and then as far as liabilities go, we have payroll, which is pretty straightforward. Liabilities held for sale, that's only came up once back in 2019. Haven't seen it since then, so not anything that I don't think we really need to look into. Debt, again, it's just loans that they have outstanding. Taxes, of course, and then, oh wait, I'm sorry, let me explain this. I apologize. So there's because this doesn't happen often, but there's two pension entries on the balance sheet. One is pension assets, the other is pension liabilities. And the reason why is because what the company is doing is they put money into the stock market, they put money into investment fund for the purpose of funding the pension, right? And so what happens is sometimes is that those securities, those funds actually end up generating more money than what they need for the pension. And so that is considered an asset that gets put on the books. And that'll be really important here in a moment. So this is the liability pension. This is the actual pensions that they have set aside for their employees. Leases, exactly what it sounds like. Other liabilities, I wasn't able to get a lot of information on this, unfortunately. I went through the statements. I went through two different statements trying to find this stuff, and I just wasn't able to find anything. From my understanding, a lot of this has to do with their environmental cleanup, right? So what happens is that because they are, a paper company, they deal with the environment. They use a lot of water, they cut down trees, they have lumber mills, yada, yada, yada. And so they are, or they have been named in about half a dozen different environmental, can't say disasters, but environmental cleanups, right? And so what they do is they do their very best to try to figure out how much they're going to have to spend on these cleanups before they have to actually spend it, right? And so that gets put down as a liability. There is some other stuff in there, honestly, but I just wasn't able to tease out exactly what it was. It's really frustrating, actually, when you have a fairly large entry on the balance sheet that they just put other, just miscellaneous, you know. It's legal, there's nothing wrong with it, right? But for an analyst, for an investor, trying to really get into the numbers, it's tough. And like I said, it's definitely frustrating. All right, and then what we have here at the bottom, it's just a net. And what that simply means is I take assets minus liabilities, and that gives me the actual, you know, what the company is worth, right? Because if you have $1 million, but you owe $1 million, you're not really a millionaire, and it's something that's said a lot. It's called being a millionaire on paper, where you got $1 million. So you can technically say you're a millionaire, but you owe $1 million. So at the end of the day, are you really a millionaire? No, you're not at all. So that's the reason why I do this net book value, which is also used to calculate price to book anyway. So, all right, let's go through this thing. Shares have not moved around at all, so that's really good. You don't have to worry about anything there. And then what you see here is what I call the book price. You just see price here, but I call it the book price, okay? Keep in mind, too, what you're seeing highlighted here is 2021 as of September 2021. And then we have 2020, 2019, and then 2018 over here on the far left, okay? All right, what you see highlighted is what's considered forward numbers or predicted numbers. We'll say they're predicted numbers. Again, the earnings report is coming out at the end of this month, and so we'll get a chance to actually see what those actual real numbers are. But as of right now, we're kind of just predicting what they may be. All right. So with that being said, based on the current net book value, we have a book price of $15.23. 2020, it was 11. 2019, almost 15, and then it climbed all the way up to 22 in 2018. I do want to make mention here the reason why we have such a high book price here in 2018 is because the net book value for the company was really high, and you see it dropped off fairly steeply going into 2019 down to only 6,500 from 10,000, and then it dropped again in 2020. To be honest with you, usually a declining book value is not a great thing. In this case, though, um, with International Paper, we know that they've been selling off a lot of their paper business. They're basically transforming their company. Instead of doing mostly paper, they're doing almost all packaging now, and a little bit of diapers. And when I say little bit, I mean they're still the number one supplier of of diaper material, right, in the U.S. and also I believe in Russia or Europe as well. But the point is that the diaper part is such a small um, uh, percentage of their total gross revenue that it's kind of a side business for them. Mostly right now, they are doing nothing but packaging, a little bit of they're calling it graphic, industrial graphic something, where I think they are printing on cardboard. So, for instance, you have Amazon, right? Well, it's been a while since I've gotten something from Amazon, but if my memory serves me correct, the pictures I've seen, when you receive an Amazon package, it comes in an Amazon printed labeled box. And so we know the International Paper is definitely supplying the cardboard for those boxes. But whether or not they're doing the graphics for all of them, I doubt it. And so that's a business that they're kind of getting into. Basically, just a vertical integration, kind of a one-stop shop for everything packaging, right? Okay, so currently the price is 15. Okay, now again, this is based on September 2021, not the full year. The statistics say 16, almost 17. Um, Hard to see that happen, but interestingly enough, again, like I said, we saw this declining book value, but then here in 2021, all of a sudden, book value is 68, which is higher than it was in 2020. So the question becomes, what happened to cause that? And as far as I can tell, I'm gonna actually get rid of this column here. All right, so just side by side, looking at these two numbers. This is 2021, this is 2020. And I'm just looking for any differences. And right here we see a big one, which is the pension liability. And that makes a lot of sense because up here we see a pension asset, which is a crazy number compared to what it has been the last 3 years. What that tells me is that clearly their investments have paid them handsomely. Um, Either that or maybe because of their selling of a lot of the paper business, maybe a lot of those employee pensions went with it. That's also a possibility. But either way, what we do know is that currently, right now, as of September 2021, they have a net pension asset on the books. Well, I can't say net because it's still a little less than the liability. But I mean, basically, the money that they made covers the entire liability, which is crazy. So hopefully this gets discussed in the coming earnings call and someone asks the question that I'm burning to know, which is what the heck are you going to do with this windfall? Are you going to just pay up the liability and get that liability off the books, thereby increasing that net book value, or you're gonna do something else with this money, right? What's going on? But either way, we're talking about the difference of what, like $600. So, I mean, it makes sense to me that's kind of what's going on here. Um, the liability loans have come down considerably, and I mean even more so than I think the last couple years, because from 19 to 16 was a 15% drop. We had a small increase between 19 and 20, but then we have another roughly 15% drop between 20 and 21. I don't expect that to change within, you know, October through December. I don't expect that to change much at all. And so that 3,000 may just be what put them up above, net book value, or increase their net book value this year. Let's see what else. Yeah, of course the pension helped. But you know what? The investment though, which is really weird. And again, maybe this has to do with their divesting of some of these companies. But last 3 years, their investments have been about 8 grand, and all of a sudden September rolls around and they're only at 3. Again, I don't expect that to change much at all. So let's go ahead and let's make that 3,000. I can't imagine. I mean, maybe they take some of the cash that they have and put it into some investments, especially because of the great, obviously the great thing that's happened with them with the pension investments. That's something that can possibly happen within a 3-month time frame, but let's just assume that it's going to stay about the same. Let's see, everything else pretty much the same. Um, the inventory. The inventory is interesting. This is actually something I played around with. So let's see what it's supposed to be. Because the statistics say, based on the drop that we've seen over the last 3 years, that inventory is going to be a negative, and we know that that's not possible. It can't be a negative, right? But they did talk about inventory in their last earnings call, and they said that basically, they can't keep up with orders. As soon as they're making something, it's getting sold. The only issue that they've been having is shipping things from, the lumber mill to, let's say, the plant where they're actually making the cardboard. That's been a bit of an issue, and that sometimes can slow up or cause an increase in inventory, but I don't expect there to be a huge increase. And so I think keeping that number right about 2,100, I think is okay. And then as far as the receivables have come down pretty much consistently the last 3 years. And I always say, one time is a fluke, 2 times is a coincidence, third time it's a trend. That's consistency. So whether or not, now you see here in 2020 it's 3,000, and September 21 it jumps up to 35. The question becomes, in a 3-month period, does that change? I think it can. I can imagine though that, if they're talking about having the supply constraints, and they're talking about, you know, um, selling things as fast as they can make it, maybe a great thing is that they're actually getting more orders in than what they can fulfill, so they have more receivables on the books. Because the way it works is, when someone calls you and says, "Hey, I want 10,000 boxes," as soon as they say they want 10,000 boxes, that gets booked as revenue. The other side of that transaction is accounts receivable, because now you have a purchase order that they owe you money on now. That's a receivable, okay? And then once you ship those boxes to the customer and they pay you in cash, then you no longer have a receivable, but now you have cash. And that's how the double entry accounting system works. And so it is possible that, for sure, we'll see receivables come up. and they have obviously come up. The question is, do they stay where they are at 35, or do they come up even further? I don't know. That's a hard one to come up with. The statistics say that it drops down to 28. Um, but like I said, it's at 35 now. There's no way they're going to ship so many boxes that the receivables come down that much. If they do, that's great. That means that they're going to blow the doors off of earnings this month, right? Um, I just don't see it happening. So for right now, we'll leave it at 28, but we may play around with that here in a moment. And then cash on hand, like I said, this is an interesting one. Currently, the actual cash on hand is 21.22, which is still 4 times what it has been over the last 3 years. The statistics say that it's going to be the same because it always has been the same, and statistics doesn't understand when these fluke things happen, right? And so this is definitely a fluke. Of course, if we had more data to look at, maybe we find out that it's not so much of a fluke. Maybe this has happened 10 times before in the last 20 years. But as of right now, we're considering it a fluke. So we cannot use statistics in that case. All we can do is just kind of assume that it's going to be about the same, which is the 2122. Yeah, 2122. That can definitely, like I said, I mean, if receivables are going down, cash is going up, period. So we'll see how that goes. Now, let's see where that puts us at. So that now gives us net book value of 37, 37 versus the 68, which is pretty far from the 2020 of 52. Let's see just how far it is. Curious. I mean, if this is a roughly 20% drop, then I mean that may be what's going to happen here. I can't do that math. Let's see. 28% drop. I mean, it's possible. It's possible. A 28% drop. Um, what tells me though that that's probably not the case is because look what happened with the book price. It fell all the way to 8, and we know last 3 years it's been nowhere near 8. So it's got to be at least 10. So what we need to do is we need to either reduce some liabilities or we need to increase some assets. So, oh, here's one thing we missed actually. Um, the pension liability. Um, it's come down. Every single year it's come down. Again, this has to do, I believe, with the divestiture of a lot of these paper companies. And so the pension is leaving with these employees. And that's the reason why their pension liability has come down so much. The cash hasn't moved around very much. And we're not seeing any, really increased liabilities either. So they're not getting loans to pay off the pension, right? So that means that the literal pension liability is just vanishing because of these employees are leaving. That's the only thing I can come up with. All right, with that being said, what we then have to do is we have to assume that, of course, it is going to drop, right? Now, the statistics say that's going to drop to 900 from 13, but it's currently at 653. That's where it's at. It's at 653. That's almost a 50% drop from 2020. And the question is, does it stay there? Does it continue? Let's say it stays there, right? Let's say it stays at 650. What else can we play around with here? As far as payroll goes, payroll has pretty much stayed the same. It's dropped a little bit. Statistics say 426. It's currently at 489. I don't know. I we'll leave it there. All right. Then as far as assets go, oh yeah, that's right. This pension asset. I don't see the pension asset going away. But man, 545, 500. That's a big number. It's a big number. Let's see. That gives us a price book of 10. Here's the other thing that's important here. Remember, they do have restricted cash on the books of $14.99. I don't know if that restricted cash goes away. Let's assume it doesn't. Gonna get put on the books, and so that gives us a book value of right around 6,000 versus the 68 that is currently at. That still gives us an increased book value, which I think will bode well for this particular company that's seen a declining book value over the last 3 years. Again, it's hard to imagine that suddenly the book value is going to increase, but maybe with those investments, that's just where we are. That gives us a book price of 13. Sounds a bit more in line with what it has been over the last 3 years. That gives us a price to book of 3.5. Again, this is predicted. Let's make sure we get that. Let's see. Just want to make sure 23. Yeah, that is predicted. Currently, it's at 4, and it has been, 4, 3, and 3. And so 3.5 puts us really right in the middle of that range, historical range that is. And so that gives us stock price of 54.53. Let me make sure this is based on 25. Okay. Yeah, so yeah, 54.53. This is going to be based on current sentiment around the company. Okay, current sentiment, and what I mean by that is that, and I've said this before, but when you are dealing with stocks, you're also dealing with funds, you're also dealing with institutional investors, you're also dealing with macro outlooks, meaning where people think the economy is going to go and how that affects their investment decisions. A lot of times doesn't have anything to do with the company itself, just has to do with people's preference. And we do know that right now the consumer cyclical sector is not doing so well compared to the rest of the sectors. Right now, those defensive companies are really where the money is going. Real estate, utilities, consumer defensive. International paper is part of the consumer cyclical, meaning that even if someone is not necessarily investing in international paper directly, they may be investing in a consumer cyclical index fund, right? And so when money comes away from the fund, money also comes away from international paper because the funds own international paper. I think I have this pulled up. Institutional ownership for international paper, I believe, is somewhere in the neighborhood of 80%. Let's see. Do I have that? Yeah, here we go. Slowly but surely. That's at the top. Always queue up the bottom, but okay, yeah, 80%. So 80% of the entire stock is made up of institutional investors, meaning Fidelity, meaning all of these funds, right? And so a lot of times these funds, T. Rowe Price, Invesco, I mean, all these guys, Ameriprise, right? Morgan Stanley, you so, Wells Fargo. So we're talking like if 100 employees decide that they don't want their retirement funds being in um, a growth fund, let's call it, right? Then they'll take their money out of that growth fund and put it into maybe a more stable fund. And so typically something like a consumer cyclical company will be part of a growth fund versus a more stable fund. Okay, that's a very broad brushstroke, but that's basically how it works. And so the meaning of that and the reason why that's important is because when we look over the last 3 years, the book price as a portion of the stock price, okay? Let me make sure I get this right. Mm, Yeah, the book price as a portion of the stock price has been higher. All right. And so what that means is that there's only two things to own with a company. Okay, you own what they actually own, right? Like their profit, their property, their assets, right? You can own that stuff. That makes up a portion of the stock price. The other portion of the stock price, which is almost always true, is going to be what's called intangible value, right? Which means that it's just the excitement for the company. Okay. And like I said, the excitement for the company wanes over time. And sometimes it doesn't even have anything to do with the company itself. Sometimes it just has to do with the sector that the company it happens to be in, or maybe even the country that that company happens to do business in. There's a lot of institutional investors that'll sell a fund made up of companies that do business in a particular country. And so if someone decides one day, well, you know what, companies doing business in China are just not great to invest in right now, they'll take their money out of those funds, and then those funds are sometimes forced to reduce their positions or sell their positions because their clients don't want to purchase those companies. And so the stock price for those companies will fall as a result. So over the last 3 years, we see that the actual stuff that the company owns has made up a larger portion of the stock price, meaning that there wasn't much excitement for this particular company. Okay, that has changed though, and it makes sense because, like I said, this is a company that is transforming. It's becoming something new. It's becoming something exciting. When you think about, COVID, when you think about lock-ins, when you think about everything going to the web as far as how people shop and stuff like that, packaging packaging. And that's what these guys do. They're the number one suppliers of packaging. If you want a box, International Paper is supplying it, period. And so that's a great thing. That's a great story. And so the excitement is building, and we see that in the numbers. In 2020, that number was 24%. Currently, it's at 25%. And so what I did here in my analysis was I looked at the current number of 25%, and I came up with 54, 53. Currently, the price is trading at 47, and so of course that makes this particular stock undervalued. Okay. But if you were to look at the historical um, average for the, let's call it excitement in the stock, that actually brings the price down to 44, which overvalues it. And so this has been really hard for me going through this, trying to really dial in and pinpoint kind of what to say about a stock that's literally kind of in between um, what's basically an overvaluation and an undervaluation. Um, I'm going to assume, I'm going to say now that even though this is in a sector that's not quite great, and honestly may not be great for some time because typically those consumer cyclical stocks do really well when there is a bright outlook on the future, right? Where we think that, man, people are going to spend a lot of money, people are going to shop for a lot of stuff. People are happy and excited and they're going out and they're going to buy things, right? Um, that makes people say, "Oh, I want to put my money in growth companies. I want to put my money in those companies that make money in retail. You know what I'm saying? I want to put my money in companies that do most of their business in the United States, maybe, right?" Um, then we'll see those consumer cyclical stocks like the Best Buys and the McDonald's and that kind of thing just really skyrocket. I don't know if that's going to happen anytime soon, and I think that's kind of why we're seeing the price where we're seeing it. Remember, 3 months ago when I looked at this thing, I said that it was basically undervalued then, and though the stock price has not moved below my lower range, it hasn't made it to the top range either. I mean, granted, it's only been 3 months. It's not really supposed to, but again, it hasn't performed very well, which is why we're doing this. So that's all I can say about the book value. It's in between. I can say that it's overvalued based on current outlook, current macroeconomic outlook. How about that? So I'm going to call it 44 is where I have this stock valued at $44, which again makes it overvalued. All right, let's look at the earnings though, because this is a bit of a different story. Um, the oh wait, I did this first because my concern was not only potential bankruptcy, but also dividend cut. Now, they have cut the dividend. Now, they haven't done away with the dividend. They're still paying a dividend, but they reduced the dividend so that they're not paying as much right now. And so that's concerning. We don't like that, right? We prefer them to increase the dividend because that puts more money in our pocket. So what I did was I went back and I basically calculated how much they have paid out as far as a dividend over the last 3 years. And these are the numbers here: 818 in 2018, 855 in 19, 872 in 20, and then currently so far they're at 862. The statistics. Oh, no. Sorry, no. This is actual. Yeah, this is actual. Sorry, actual 2021 is 831. Okay, 831. And 463. Okay, yeah. So it's just the way the dates fall is what it. Because I thought this was weird too when I first did it. It's even weird at it. But yeah, it's just the way the dates fall. They've already paid out 4 dividends for the year of 2021, which is why there's no need for us to predict what that payment is going to be. So I did write it in not highlighting it. Okay, so anyway, the first thing I wanted to do was see if the cash that they currently had in the bank was enough to pay the dividend. And I can tell you in the last 3 years, cash on hand has not been enough to pay the dividend. Currently in 2021, it is. They have that extra amount of cash that's there. And you can't see it here, but I did subtract that restricted cash from the balance sheet in that calculation because, again, like I said, they can't use that cash. So even after taking out that cash, they still have twice the amount of cash needed to take care of the dividend. Like no problems, no issues, right? That hasn't always been the case. And so I then looked at what the profit was, right? Can they pay the dividend based on their profit? Because that's literally how dividend gets paid. All right, you make money, and the money that you make is profit, and that profit is what you use to pay. No about it. For the last 3 years, they have had 2 times the amount of profit needed to pay out dividends. So why they reduced the dividend, I don't know. It hasn't come up in earnings call. Hopefully that's something that will be discussed in this upcoming earnings call, or it will get asked, and we'll get an answer to that and find out whether or not they're going to make any adjustments going forward. I have to imagine that the reason for the cut, well, actually, I know the reason for the cut, but it's it's not very straightforward in my mind. So what they did was, remember, they split the company in two basically. So the part that went to the paper part, the printing paper. They actually, when they split the company, what they did was they said, okay, because you own International Paper, when we split the company, we're going to give you a piece of the new company. So currently, Texas Investments has something like 9 shares, maybe 20 shares, I forget. I think 9 shares of the new company, and that new company also pays us a dividend. Matter of fact, we just got paid a dividend on that new company, and then I think the way the math works is that the dividend for the new company makes up for the cut in the dividend from the old company. But again, like I said, to my mind, it's not that straightforward because you still reduce the dividend. You know what I mean? Like you gave us, like you gave us some cash. We appreciate that, right? Because you sold the other part, so that's cool. You sold that company. We got a piece of it. That company's paying us a dividend, but that's our business with that company. That's not our business with you. You still reduced our dividend. So anyway, point is the dividend is safe. There won't be any need for them to stop it or anything like that, and I don't think they will reduce it further. Matter of fact, I can imagine that if they do end up reporting good earnings over the next couple quarters, they may even raise it up again. All right, so let's look at the income statement. Revenue has consistently come down over the last 3 years. Again, that has a lot to do with the fact that they've just been basically getting rid of revenue producing businesses, right? So currently they're at 16.9. Statistics put it at 19, which I'm fine with because it's a smidgen under 2020. Maybe that number is 18. Statistics say 19, so we're going to ride with that. Cost of goods sold, again, has consistently come down. And again, it has everything to do with the fact that they've been getting rid of businesses. The one thing, though, that does bother me a bit with these numbers is that typically you want to see the costs go down more than the revenue, right? Because if I'm getting rid of a business, that means that I shouldn't be spending the same amount of money to run the new business now that I have the old business going. So the cost of goods has come down, but it hasn't come down more than revenue. So they're getting rid of money and still paying same amount, basically. So it's not great, but either way, 2020 they were at 14. They're currently at 11, which is awesome. Whether or not it's going to stay at 11, I don't know. The statistics gives us 13. Oh, wait. No. Okay, yeah. So this is what I did. I didn't use statistics on this one because I think the statistics was way off. Let me look at that real quick. I think statistics were way off, and that's the reason why I did that. Let's see. No, it's not that far off. 13,756. Well, I did this two different ways, and I'm sure I'll figure it out at the bottom why I did it that way. What I did was I looked at gross profit. Okay, gross profit is simply revenue minus cost of goods sold, and then from your gross profit, you can start deducting payroll and your light bill and all that kind of stuff, right? So it's a very important and very common number to look at when you're looking at companies that sell things. earnings. Okay. So their gross profit margin has been 66, 67, and 70. It's currently at 69. The average puts it at 68, which is just under that 69 number. And I can believe that we're going to see it come down only because it's so far down now. Um, when you think about the fact that we're missing an entire 3 months of the year, um, it's still, and that's the reason why I did the gross percentage, right? Because even though we are missing 3 months of the year, the 13,756 is still, I'm going to do it up here, it's still close to the 70%, I believe. Let's see. Yeah, see, it puts it at 71, which is a bit higher. And I really do think that they're going to bring that number down. I really do, only because they have been. I think they've been purposely working on that. They've talked about that in their earnings call. So we're going to drop it just a bit more down to 13, which puts us again, like I said, at roughly 68% gross profit margin. All right, payroll. It's come down consistently over the last 3 years. Currently, it's at 1255. The statistics puts it at 14. Does it rise a buck 50 in 3 months? Maybe. I don't know. It's still a drop from 2020, so I say we kind of leave it there. The distribution has to do with the cost that they spend money getting the stuff out, right? And that's come down barely. Might as well say it's been even over the last 3 years. So I don't expect that number to move around at all. But statistics, well, not statistics, but rather the 20, the current September 2021 number is 1272, which is way down. And so, do we see another 300 in distribution over the last 3 months? I think it's safe to say we will, and so that's the reason why I just let the statistics do the math for me, and that puts it at 1543, which is just a smidgen below 2020. All right, tax is something that I really had to play around with. Reason being is because it's really just been all over the place, and from my understanding, that has a lot to do with their not only divestitures but also there's been some issues in Brazil. There's been some issues along the lines of amortization and depreciation of not only their forest holdings, um, but also dealing with their goodwill and things of that nature. Because they've been purchasing some packaging businesses too. Small acquisitions, not enough to really move the balance sheet one way or the other. But I think that's the reason why we're seeing the tax move around so much. And so 618, 819, and then 400 in 2020. Currently it's at 478. I just chose an arbitrary 400 for tax. So maybe it comes down, maybe it stays up. I don't know, honestly. So let's just give it 500. I don't think it'll be much more than that. But again, it's been so all over the place the last 3 years. Who knows, honestly. All right, and then the other income. Now, the other income comes from those companies I told you about that where they sold them, but they maintained 20% equity or whatever. So those companies are paying them a dividend every month or every year or whatever. That number has jumped around quite a bit. It was 154 in 2020. Currently, it's at 245. The statistics, I think, are giving me a wonky number, which is why I chose Let's just see. Oh yeah, that's what's going on. So the statistics is telling me that they will actually owe money to those companies. That's not gonna happen. So that's not gonna happen. So statistics is not gonna work for us in this case. And the reason why the statistics are kind of all over the place is because this number's been all over the place. You know, a 75% drop, and then it kind of evened out, but then it jumped up to 245 here in 2021. So I think that number stays about the same. So let's put it at 250 and see kind of how that goes. All right. The investments. This one is fun. All right. So over the last 3 years, we see that the um, the investments um, have been an expense. All right. And all of a sudden in 2021, they've actually made money in those investments. And this goes back to the whole pension thing with the balance sheet, right? Something has happened. I didn't look into it. I have to assume it has something to do with maybe foreign exchange, or maybe they just made a lot of money on some sort of maybe interest rate security. I can't be certain because there's nothing that's really moved around that much to cause that huge of a difference between last year and this year. Interest rates haven't moved around very much. Um, Foreign exchange is the only thing I can think of. That these companies, what they do is if they make a dollar in Chinese yuan, then what they'll do is they will purchase a security to cover that $1 in Chinese yuan, so that if the Chinese yuan falls in value, the security that they purchase goes up in value, so that they don't lose any money. And so sometimes what happens is that security that they purchase goes up in value more than what the Chinese yuan dropped, and that's why they would actually make money back on these types of investments. So the statistics say that they're going to have an investment expense similar to what they've had in the past, because over the last 3 years, that number has increased by a lot, 100% increase, matter of fact. Um, but currently it's at uh, uh, an income, and in the last earnings call, they talked about having to pay more for fuel, and I really just lambasted them in my earnings call summary, where I said, like, what are you guys doing as far as management? Like, you you know what the cost is. Why don't you have hedges against this stuff? Obviously, they have a hedge somewhere, and it's paid handsomely. So best I can do is say that over 3 months, that investment is going to somehow reverse course, and it'll no longer be a benefit. I mean, that's hard to say, let's give them the benefit. Let's just say it decreases a little bit, right? All right. So, interest income. Now, this is really nice to see that the interest, I'm sorry, not interest income, interest expense has come down consistently over the last 3 years. And so we expect that to be the case, but it has dropped by a lot in 2021. Does that increase in over 3 months? Maybe, maybe not, but the statistics puts it at 398, which is in line with what it's always been. So I don't see why that is not the case. Currently, like I said, it's at 242. We'll see. Again, we have pension. This is money that they've made on the pension. I mean, like I said, 2021 has been really good to them as far as the stock market and their investments go. So do they keep that benefit, over these last few months of the year, or does that benefit go away? I don't know. Right now, we'll leave it at zero. We'll assume that kind of reverses course. Okay, so our net predictive amount, net profit 25, 24, which actually is an increase from 2020, even though we have seen a declining net profit over the last 3 years. And so currently it's at 25.78, you know, and the two biggest differences here are this pension benefit and this investment benefit. Um, those seem to be making all the difference here, and we'll talk about that here in a moment. So let's take a look, and I want to go back to and show you my last analysis because I want to say it's at 575. Let's see. So 3 months ago, the current earnings per share was $4.89. I said then, well, I didn't say, the statistics said that if earnings were to improve, they will improve to roughly 572. And if they improve to 572, then we can see the stock price make it all the way up to 56.34. So currently, right now, September 2021, earnings per share is $5.74. Now, the question is, what price did the stock get to based on that $5.74? Well, the high, which wasn't necessarily around earnings at all, but the high was 61.81. Okay, so that means we're pretty much in line with what I said. Earnings improve to 574. We can see the stock price go to 56. The high was 61, which again didn't have anything to do with the earnings, but it did make it there. So in that sense, we're right there. So the predictive earnings per share 562, which is a little bit off of the current earnings per share, which gives us a PE of 10. And I came up with that PE based on the last 3 years and the current PE of 10.76. Again, this is my PE ratio, not what you'll find online. But with that being said, I am curious to see what they have the PE at. There we go. All right, P ratio 10.35. So there you go. So my 10, what did I say? 10.76 is not far from that. And remember again, when they do those PE ratios, that one says trailing 12 months. So that means they're calculated pretty much the way I'm calculating it. And they got 10.35, I got 10.76. They do include depreciation and amortization. I do not, okay? And I did think about kind of showing improving why I don't do that, because the company went on and on in their earnings report about exactly how they evaluate the amortization and stuff like that. And it's just, there's no science to it, and it's not a real expense. It's not actual money that they're paying. It's just something that you do for tax purposes, honestly. So I don't include that in my calculations. You won't see that here in the income statement. You're just seeing revenue, gross profit, blah blah blah, right? So there's no amortization or depreciation there. So again, predicting 10.15, which is a little under the current 10.76. Um, you know, it's hard to. I mean, the prediction is that they're definitely going to have a net profit uh, growth um, um, from 2020 to 2021. No question about it. That's going to happen. Something crazy will have to happen for that to change. Matter of fact, just to play around with this thing, let's bring the investment down to zero, and they're still going to have growing profits, which they haven't had in the last 3 years. And that is awesome. That means that the company is doing the right thing. They're doing what they need to do to make more money. That is great. And stuff like that really helps boost the excitement for the company and for the stock when you have a company that's been not losing money, but they've been, like I said, when you look up net profit growth and stuff like that, you see a company that's declining year after year, you don't want to invest in that. But all of a sudden, now you see a company that has growing profits, and you're like, oh, that's a company I want to be in. And so that makes people want to purchase the stock, and that boosts the stock price as well as the PE and all that good stuff. So um, it's hard for me to say that the PE ratio is going to be less than what it is now, meaning that the company is going to be even cheaper. Hard to say that. And we may, play around with some of this stuff, but I have that at 12% of the stock price. And if you look historically, it's been 11, 12. In 2020, it got down to 8. Okay, it got down to 8 in 2020. Currently, it's at 9% of the share price. Um, you know, I would love, let's see, 28. Yeah, that's at the current price of 46.98. So let's do this math, okay? So if I wanted to get the earnings to roughly 10% of the share price, I would have to make this price, let's say 48. Oh wow, not even that high. You don't have to move it much. Oh wait, no, I guess I do. 50. So now, yeah, there we go. Let's go to 52. That's kind of the number that I was looking at last time. Oh wow, not even 52. Let's see, 54. That's where we purchased it at. There we go. So 54 really puts it more in line with what it has been historically. And again, this is based on predicted earnings per share, which is actually less than what it is now. So anyway, that gives us um, a price of 57.8 cents, which is currently under valuing the stock. It's at 47 right now. Based on this information, we looked at the book valuation, which put it at around 44, again, kind of based on a macroeconomic outlook, which, again, overvalues the stock, meaning that it can definitely fall further. Um, and then we have a high of, what was it, 54 and now 57. Um, and this is based on earnings. And personally, I think the earnings story is the best story in all of this. The question is the rest of the market going to believe so or think so as well? And let's call it what it is. It's belief, because you're talking about, this year, right, having net profit growth. But the question then is that going to continue for years to come? If you believe that it will, then there's no question that this stock should be at 57, 58 bucks. If you think that this is a fluke and you want to wait around for a coincidence, right? And then wait around even more for that third, consistent, okay, this is a trend. We can see the price languish between that 44 dollars and maybe $54 for the next 6 months, you know. Um, I did pull up to um, the options market. We looked at that last time we did this. Um, no, it must be this one. Nope, can't be. There we go. Because I do think this is interesting. So 6 months from now, the options market has the price at no higher than 60 and no lower than 30. Okay, so 6 months from now, they have it at the lowest of 30, at the highest of 60. At this point, I can agree with the $60. I don't agree with the $30. There's no way it gets to 30 or below unless something really drastic happens as far as I don't know. Well, honestly, we would be talking about people not being able to purchase things on Amazon, basically. At this point, I don't know if that's the case though, because it seems to be kind of a staple of where we are right now. Um, Still cyclical though, because things change with holidays and this kind of thing. All right, so if we look out a year from now, um, the options market has it at a price no lower than 22.50, which again is crazy when you think about where it is now. But the more time you have, the more opportunity you have for bad things to happen, right? And so the options market doesn't see it getting higher than 90 bucks. And I have to say that at this point, as you can see, and I'll explain this here. This is open interest. Okay, these numbers here. This is the number of people willing to trade at these prices. Okay, and then this is the actual price for the option. And typically, with option prices, you see a nice gradual increase or decrease as you get higher or lower for the price. Currently, because this is so far out into the future, the options market can be really topsy-turvy. So you see there's a lot of people willing to make a trade at $70, thinking that the price is not going to go above 70, right? But because there's so many people willing to make that bet, the price for the option is only 5 cents. So that means that for someone like myself, it's not worth me making $5 to sell you my shares at 70, and I have to hold the stock for a whole year. right? So that means that if the stock price goes way down, I lose not only money on the stock price going down, but I also lose money on the option as well. It's just not a smart thing to do. Not so far out anyway, right? Um, and then here at $90, it's that they're like trying to tempt you with this 50 cents, or $50. Like, it's kind of crazy. At 75, they're offering $200. So anyway, the point being here again is that the options market doesn't see this thing. Uh-oh. This happened earlier too, and I don't know what I'm doing to cause that. It's just like Yahoo Finance. It's just one of those things where I swear it's the website. It's not me, you know? But I do feel like I did touch something or hit something though. All right. And now, so again, just going back, don't want to get too far into the weeds on this. Basically, options market has this thing no lower than 30, no higher than 60. Again, I agree with the 60. Um, the other thing that I think was interesting um, was the institutional owners and what they're doing. Because, like I explained before, what the institutional owners do is really what moves um, the stock. Someone that owns 1,000, 2,000 shares isn't really going to move the price around very much. But these big banks and big investment funds that's trading, thousands and millions of shares sometimes, they're the ones that really push the price around. And so we see that 376 increased their positions, meaning they already owned the stock and they just bought more of it. 432 decreased their positions, and 183 didn't do anything. But I want to show, must be underneath this. There we go. Um, 61 brand new people bought into this thing, but 106 sold out. What is interesting though is of the 61 that made new positions, they purchased 4 times more shares. That's interesting. So there's a lot of people who said we don't want anything to do with international paper anymore, but those were fairly small positions, even though it was 1.8 million shares. Those are small compared to the number of people that came in and actually um, purchased shares. And usually, when someone initiates a new purchase, it's because they think that the stock price is fair, right? When the stock price is really high, typically you'll have people sell and not necessarily purchase brand new shares. You know what I mean? It's more likely that if you already own the stock, even when the stock price goes high, you may buy more because you think it's a great company, right? But for someone not to have any shares at all and they decide to buy some, typically you can say that they've done that because they think the price is fair or they think that the price is undervalued for the value of the company. Even though, like I said, we have way more that sold out, a lot less shares had left. And then as far as the number of people who increased and decreased their positions, same situation. More people decreased their positions, but a lot less shares than persons who increase their positions. So just based on what the institutional investors are doing, aka the smart money, it looks like this thing is fairly valued. And like I said, I'm excited. I really am. I'm excited about the prospects for the net profit growth. I'm excited that I think the company is going in the right direction. If they were to keep net profit roughly what it is now, that gives us a price of $58.80. So here's what I'm willing to say. Okay, based on assets, liabilities, things that they own, you know, I'll say that it is. This is hard. Um, I'll say that it's undervalued at 44. No, I'm sorry, overvalued. It's overvalued. So I'm saying based on book price, I'm showing it valued at $44. All right. Based on earnings, however, which I think is the more interesting story, the stock price is undervalued, and I have it at what are we doing? I have it at 57, right? The other thing I think is important to note here is whether or not the company is trading on book value or earnings. You know, I do have the historical number here. Let me put that back up. So currently it's at 47. Over the year of 2021, okay, from January all the way December, the highest price has been 61.81. All right, so it's been there. I think it can get back there, okay, because this is talking about 2021, which, like I said, is seeing net profit growth, right? And I think that's why we see such a huge jump from 2020 to 2021. 2019, 45.68 was the high, 48.42 for 2020. Back in 2018, we saw a high of 63.69. So there's no reason why we can't get back to that 61 if things trade as they have traded, right? Um, if the consumer cyclical sector continues to languish, if it continues to underperform the rest of the market, like I said, it may not get to that 61 for quite some time. It may not even get to 60. Um, and so I'm going to say 44 to 57 to be conservative. 60 is definitely where the options market think it can go within the next 6 months. So that's where we're at, between 44 and $60. Let's call it 57. So our program is calling for more shares. I think that the prudent thing to do is to try to get in at that 44 number. Okay, if it gets down there, great. We know that we're getting the stock at the bottom. If it doesn't get down there, then we know that it's going to either stay where it's at, because right now it's at 47 or 48, which is, I'm sorry, 47. It's at 40. Oh, shoot. Where is it now? I believe it's at 47. Yes, yeah, it's at 47. So it's at 47, which is not far from 44 at all. If it doesn't get to 44, then it means it stays basically at 47 and rises from there. So we're going to try to get in at 44. If we can't, whatever. I think the price is going to stay where it's at. At some point, though, I do think that the consumer cyclical sector will find some footing and will rise again, but it's going to take some time. You know, we're still dealing with these so-called supply constraints. We're still dealing with the fear with COVID and stuff like that. We're still dealing with, the pending interest rate increase. And International Paper has said too that they have had some issues raising their prices because they're dealing with, huge companies. Amazon can basically name their price. You know what I mean? Like you don't tell Amazon what you're going to charge them. Amazon kind of tells you. So that's an issue when you're talking about inflation and rising costs and stuff like that. Um, So we'll see. We'll see. 44 to 57 is where I have it at.